We need to get to a healthy single best chart here, Scarlet.
All right, we're going to focus on the global implications of a slowdown in China. The country's appetite for Australian iron ore or Brazilian oil seeds is a shadow of its former self. This chart is from Deutsche Bank's chief international economist, Torsten Slock. And of this group, pay attention to the white line. Australia, it is the most dependent on China. More than a third of Australia's total exports go to China. Brazil, which is the purple line, the yellow line, there we go, leads the second group. It's seen the biggest drop-off in demand from China. It used to send about 20% of its exports to China. Now it's about 12%. And we've kind of bunched South Korea and Japan in there as well, the purple and the red line with that second group. And at the very, very bottom, you've got the U.S. and Germany, the blue and the green lines. The U.S. exports to China dipping slightly. Germany actually seeing a pickup ever so slightly in exports to China. Slock does say that some of the data out of China is a little bit worrying, industrial production notably, and inflation-adjusted GDP.
Jeff Dennis with us with UBS to bring us up to date on slower economic growth in China. Is the party over?
No, I don't think so. We just think it's just slowing down, and it's a classic soft landing. It's heading for probably sub 7% growth next year, probably 6.5% growth in 2016.
What's it mean for commodities?
I think you've seen the big impact on commodities already.
And then you overlay Saudi Arabia on it, telling North Dakota what to do, and those are two big issues.
Absolutely, but I think the big impact from China on commodities is as we discussed earlier, it's the impact on iron ore prices, on base metals, as opposed to on oil.